Federal Reserve Chairman Jerome Powell on Friday clarified that loan costs were probably going to keep moving higher in the national bank's continuous bid to subdue high expansion. The Fed plans to utilize its policymaking instruments strongly to bring request and supply into better equilibrium, Powell said during his feature address at the Federal Reserve's yearly Jackson opening monetary discussion. The U.S. Central Bank has already raised its overnight lending rate 4 times since March to a scope of 2.25% to 2.50%. Furthermore, it's supposed to climb rates again when the Fed-led representatives meet 1 month from now. That implies purchasers will again confront the subject of where to stop their investment funds for the best return and how to limit their acquiring costs. Home loans lock in fixed rates now. Contract rates have been increasing over the course of the last year, jumping more than 3 percentage points. The 30-year fixed-rate contract found the middle value of 6.29% in the week finishing September 22, up from 6.02% the prior week, as per Freddie Macintosh. That is beyond twofold what it was in mid-September of last year, 2.86%, and prominently higher than where it began for the current year, 3.22%, and mortgage rates may climb even further. So on the off chance that you are near purchasing a home or renegotiating one, secure in the most minimal fixed rate accessible to you straight away. That said, don't hop into a huge buy that isn't ideal for you since loan fees could go up. Racing into the acquisition of a first-class thing like a house or vehicle that doesn't fit in your spending plan is a recipe for inconvenience, paying little heed to what loan costs do from now on, said Texas-based certified financial planner Lacey Rogers. Bank savings. Shop around. If you've been stashing cash at enormous banks that have been paying close to nothing in revenue for bank accounts and authentications of store, don't anticipate that should change on the grounds that the Federal Reserve is raising rates, MC Bride said. That's because the big banks are swimming in deposits and don't need to worry about attracting new customers. Because of the large players' pitiful rates, the typical bank reserve funds rate is currently only 0.13%, up from 0.06% in January, per Bankrate.com's September 14 week-by-week review of foundations. The typical rate on a 1-year disc is presently 0.77% as of September 19, up from 0.14% toward the beginning of the year. But online banks and credit unions are looking to attract more deposits to feed their thriving lending businesses, MC Bride said. Therefore, they're presenting far higher rates and have been expanding them as benchmark rates go higher. So shop around. Today a few internet-based bank accounts are paying more than 2%. Furthermore, top-yielding 1-year albums offer as much as 2.50%. If you have any desire to do a switch, in any case, make certain to just pick those web-based banks and credit associations that are federally insured. Stocks seek broad exposure and pricing power. The befuddling blend of elements at play in the business sectors today makes it extreme to say which area, resource class or organization is sure to do well in an increasing rate climate, Mama noted. It's not simply increasing rates and expansion, there are international worries going on and we have a stoppage that might prompt a downturn or perhaps it won't. It's a remarkable, even interesting, blend of numerous variables, he said. So, for example, financial service companies typically do well in a rising rate environment because, among other things, they can make more money on loans. Be that as it may, assuming there's a stoppage, a bank's general credit volume could go down. That is the reason Mama proposes ensuring your general portfolio is comprehensively differentiated across values, with an openness to wares, land and perhaps a modest quantity in valuable metals. Look at being diversified across areas that historically have done well in rising rate and inflationary environments, he said. Bonds. Go short. To the extent you already own bonds, the costs on your bonds will fall in an increasing rate climate. In any case, assuming you're in the market to purchase bonds, you can profit from that pattern, particularly assuming you buy momentary bonds, meaning 1 to 3 years, since costs have fallen more than expected comparative with long-haul bonds. Regularly, they move lower couple.